You've got a foreign bank account with $12,000 in it. You think you're under the FBAR threshold, so you don't file. But here's what you didn't know. Your joint account in London at $35,000, your retirement fund in Canada at $28,000, and that $12,000 checking account combined put you at $75,000. You were required to file, and not filing cost a client of mine $100,000 in penalties. I'm attorney Chad Silver, founder of Silver Tax Group. If you're not sure whether you need to file an FBAR, call 855-900-1040 or visit silvertaxgroup.com. We'll tell you exactly where you stand. Section 1. Who actually must file? The $10,000 rule is not what you think. Let's nail this down. You must file an FBAR FinCEN Form 114 if you are a U.S. person with a financial interest in or signature authority over foreign financial accounts whose aggregate value exceeds $10,000 at any point during the calendar year. Every word in that sentence matters. U.S. person includes citizens, green card holders, residents, and entities formed under U.S. law. If you're a dual citizen living in London, you're a U.S. person. If you're a Canadian snowbird who spends 183 days a year in Florida, you may be a U.S. resident for tax purposes, and you're filing. Aggregate value means you add up every account, all of them. Your checking, your savings, your investment account, your foreign pension, your joint account with your mother. If the total hits $10,001 on any single day of the year, you're filing. Zero exceptions. At any point during the calendar year means even if the balance drops to zero by December 31st, if it was over $10,000 in March, you file. Timing is everything. Section 2. The accounts you didn't know count. Mistake number 1. Here's where it gets dangerous. Most people think FBAR only covers bank accounts. Wrong. The definition of financial account under the FBAR rules includes bank accounts, yes, but also securities and brokerage accounts, foreign mutual funds, foreign pensions with a cash value, foreign life insurance policies with a cash surrender value, foreign trusts where you're the grantor or beneficiary. And here's the one that trips up expats every single year, foreign retirement accounts. Your Canadian RRSP, that's a financial account. Your UK ISA, that's a financial account. Your Australian superannuation, that's a financial account. Your foreign business bank account where you're a signatory, you're filing. I had a client, Emma, a dual US-UK citizen living in London. She had £3,000 in her UK checking account and £9,000 in her UK ISA. She thought she was under the $10,000 threshold because she was looking at them separately. Combined, they totaled roughly $15,000. She hadn't filed an FBAR in 7 years. The penalties she was facing, even under the non-willful standard, were $70,000 for accounts she was never trying to hide. Section 3. What you actually report and how the IRS verifies it. Filing the FBAR isn't complicated if you know what to report. You provide the financial institution's name, the account number, the type of account, and the maximum value during the calendar year. Maximum value, not year-end balance, not average balance, maximum value. If your account hit $500,000 on June 15th because you temporarily transferred money in for a real estate closing, you report $500,000. The bank reported that number to the IRS. If your FBAR shows a different number, you've just created a discrepancy the IRS will notice. And here's the thing most people don't realize. Since 2014, FATCA, the Foreign Account Tax Compliance Act, requires foreign financial institutions to report U.S. account holders directly to the IRS. Over 110 countries have signed IGAs, intergovernmental agreements, to share this data. Your bank in Switzerland, your investment account in Singapore, your ISA in the UK, they're all reporting you. The IRS knows what's in your accounts before you file. The FBAR isn't telling them something new. It's confirming what they already know, and the mismatch is what triggers the audit. Section 4, deadlines, penalties, and what happens if you've never filed. The FBAR deadline is April 15th. With an automatic extension to October 15th, you file electronically through the BSA e-filing system. There's no tax due with the FBAR. It's an information return. But the penalties for not filing are some of the most aggressive in the entire tax code. Non-willful failure, up to $10,000 per violation, adjusted for inflation, currently around $16,000. Willful failure, the greater of $100,000 or 50% of the account balance per year. And willful can mean you knew about the requirement and didn't file, or you acted with reckless disregard. The IRS uses your 1040 responses to build their evidence of willfulness, even if you didn't mean to lie. If you've never filed an FBAR and you have foreign accounts over $10,000, your options depend entirely on whether the IRS has contacted you. If they haven't, the delinquent FBAR submission procedures may get you into compliance with zero penalties. If they have contacted you, you need representation immediately. Don't wait until the IRS comes knocking at your door. Call us at 855-900-1040 or visit silvertaxgroup.com for a confidential review. We handle this every day. We build it, we implement it, and we'll defend it if necessary. I'm tax attorney Chad Silver. Click like if you found this valuable and subscribe.